Hello, hello. Welcome. Thank you for joining us today, the Rabell Realty Group podcast. First of all, I want to say that video was a sold Grand Oaks new construction video that we took after the sale, but we do have lots of Grand Oaks homes in various stages, some that are completed, some of that are just the land ready for you to make an offer. And honestly, we just sold about 5 of them in the last 2 weeks. So the market's hot back in new construction in Gainesville, Florida. So if you have any questions, give me a call and I'll get you in. All right. I'm Kristen Rabell.
I'm Rebecca Johnson.
And today we have an exciting guest, Eric
Yay!
Remy of Landmark.
I'm so excited.
We're going to talk all things real estate, finances, the rates right now, right? And what else? We've got some other topics on the table as well. So we're excited to have him on. But let's first go into the Monday market moment.
All right, let's take a quick look and see what's happening in North Central Florida. All right, so December 1st through 12th, we're taking a look at Alachua and Hillsborough. So in Alachua County, we've had 55 active new properties, residential properties to sell, and 49 have sold or closed so far this month.
That's why we say real estate's local, right?
It really is.
Very tiny amount of numbers, but just almost as many sold as active in this first 2 weeks of December.
Yep, and down in the Tampa Bay area or Hillsborough County, we have 223 active and 216 sold. So people are still buying and selling, and it's definitely still a strong market, but I would say we're all still feeling an inventory shortage, yes. Especially in Alachua County, in that 300 to 600,000 price range.
About 2 months of inventory here.
Ugh, I know, scary.
Very low, very low.
All right, so let's take a look at Marion County. So Marion County, they've had 120 listings come on. And then they've had price decreases of 149, sold 90, back on the market 27, and price increases 56.
So, wow, even though there's almost 150 price decreases, there's still some increases there. And that's a pretty good number.
Yeah,
so
that was a decent amount.
I think for me, looking at these numbers and knowing at least the local market here in Gainesville, I think these decreases are because people are thinking 20 days is a long time on the market. So
It's really not.
after about, 15, 20 days, they're decreasing because they're worried. It's the end of the year. Maybe some people, and plus we've talked about this. We've heard all of the large national builders, which are very heavy in Marion County, like D.R. Horton, are trying to get rid of their inventory. And so they're decreasing every single week. So most of those are probably new construction builders of the national brand, not like in Grand Oaks where they're local, but the national ones. And then the price increases are very possible that they see how there's back on the market. They've left the market. They had to go back on the market and they've increased their price. And then some others, maybe they've done some upgrades that they needed to do and increase their price as well. What do you think?
Back on the market, I mean, I was thinking of one in Gainesville that we've seen come off the market twice and come back on the market twice because of inspections and different things. So I do think there's many factors that go into that.
Right. Inspections failed. Maybe they've replaced or fixed whatever has come up, and then they're back on the market with a price increase. So, yeah. So only 90 have sold, though, with 120 new listings. So I still think there's a crisis here in Florida with not enough inventory. So sellers, get your houses on the market if you want to get them sold. You're still getting great pricing. The prices still have not gone down tremendously. These decreases are new construction. So, all right, well, let's get on. We've got a recap of a few things that we've had this past weekend. We're in the Village, so we went to Light the Village. There's some fun people who've come in. It was actually kind of a tame Light the Village. We don't have pictures from the Tioga light up, but that one was huge. Like the Village was a little smaller. Those people were enjoying our map,
and
writing letters to Santa. So we do appreciate everyone coming. It was a nice little event, even if that was smaller. But we'll be back next year.
Mm-hmm. Oh, and thank you, Landmark, for sponsoring.
Yeah, it's true.
Oh, sorry, he's not on camera. Never mind. He's
right.
not really there. I broke the third wall or the fourth wall or whatever.
All right, what else do we have coming up? That's it? All right. Let's go ahead. I thought there was a little bit more, but let's go ahead and bring on Eric. Let's talk to him, and then we'll take a break later.
Yay,
all the excitement for Eric Ribby. All right, there we are. So thank you for coming on. We wanted to talk to you a little bit about the market, what's going on, and then some other topics we've had. So what have you seen recently?
We've seen rates kind of decline a little bit in the recent month or so.
Right.
I think the national average is about 6.3, 6.4%.
All right.
So they were over 7% a month ago. So a pretty significant drop. Biggest thing is home buyer affordability.
Yeah.
And so if you look at a mortgage payment on just a $400,000 house compared to last year, it's a significant increase. And so I think people are starting to get used to the fact that rates are a little bit higher and adjusting.
They're not going down majorly, but they have dropped quite a bit. So that's given that sting off a little to make those buyers who really wanted to buy come back on and realize, oh, better not buy now anyways. We don't know what's going to happen.
Right. And somebody that's got a mortgage statement every month that says 3% or 2.5% or 3.5%, when they start looking at numbers and they see a 6 or 6.5%, it's a little bit of a sting. They're like, well, do I want to really trade that out or can I sit tight where I'm at? So I think there's a lot of people that are on the fence and trying to figure out what's going to happen.
And the Fed is about to meet, right?
The Fed does meet, yes, and they're projected to raise rates again. That doesn't directly impact mortgage rates.
Right.
Correct.
So it's one of those things where the Fed meets, everybody hears, and they think rates go up. And it impacts us that day, usually a little better. Or
Typically, they go down a little bit the day they meet, or get better.
Depends on if they surprise us with a higher than expected increase.
What are they predicting?
Right now, 0.5%.
Really?
Okay. That's good.
Yeah, 0.5%.
But the inflation rate was higher than expected, so I know some people are calling for 0.75.
Right, yeah, and it was a tenth higher. So it's very minuscule. But the numbers that are being replaced from last year are higher numbers, so we should see the inflation numbers start coming down. So
good. That would be nice.
Yep.
Yeah, a lot of the people that are projecting rates are saying they think we've hit our peak, and they always come down slower than they go up. They go up quickly and they come down slow.
So what are you predicting? What are you seeing for the turn of the year?
I mean, we're just on a call, and I mean, it seems like everything's moving again. We've been busy with pre-quals, people out shopping. I'm sure you guys and your agents have probably noticed an uptick in that. It's projected to be a pretty good year. I mean, I saw that the price of homes are expected to be about a 1% gain, and that's kind of national. So you'll see, and you guys probably know more about this than me, but some areas go down, some areas go up. And Florida in general, I think we're just lucky to be here because a lot of people move in here.
I mean, Gainesville alone is a transient town, mainly because of UF, Shands, VA. So we're always having people move in and out. Same with Marion County, I think, with all the industries there. They come in for a little bit and then leave. I don't know, Tampa, not so much, but big cities are transient anyway. So our 3 locations that we're talking about are all in their own ways transient towns. But you have, like we've talked about for the past year, lots of people moving to Florida for very different reasons. And so, with that inventory low, it's like you said, I think it's a little harder for the people who are in their 3%, 4% house. Where are we going to go now in the 6%? But we're transient. People are still having to move all the time.
Right. People need to get into a bigger home for family reasons or maybe downsize. Right. So you have that. That's going to consistently happen. Right now, there's just no refinances. Refinances are one of those things you can't rely on in this business. Rates go up, rates go down. So the stat I just showed you, I think it was like 80% of the lenders in the business right now have never worked in a non-refi environment. So
right, and we talked about that normal market, which is a refi market, would be 2015 to about 2018. Is that the same as?
2015, 2018, 2019, rates
2019, and then
4s,
right,
to 5 in that range.
And so there was a lot. I know I refied my house at that time. I don't know if you all did.
I probably did. I think so.
Yeah.
So I know I refied my house at that time. It was a huge, tremendous, help. So I understand.
And the people that are buying now, maybe they can get a better deal. There's not as many offers. And
so that was my other question, or that was where I was going to get to. So glad you opened that up. What are you finding as a lender that sellers are doing to help? Because back in the day, in that 2015 to 2019 market, there was a lot of seller concessions, and there were more closing costs. Are you finding these buy downs?
Buy downs, and also temporary buy downs and permanent buy downs are two things.
Okay.
And then we're seeing, seller paid closing cost in general.
So that's still on there.
Yeah, and rates right now are tricky because a lot of the rates have points. Even at 6.3 is probably, half a point, whatever it is. And you're seeing that because the secondary market knows when rates come down, people are going to refinance the higher rates.
Sure.
So there's more cost up front to get in.
Interesting. So they have points when they know that the rates are going to drop.
There's a lot of uncertainty.
Can you explain the points on the very
basic level?
Basic level.
Absolutely. So when a lender tells you there's 1 point, 1 point is 1% of your loan amount in cost to you. So if your closing costs are $8,000 and your loan amount is $300,000, that goes to $11,000, $3,000 extra in cost up front. Okay, what that does on the rate is you might be at a 7% with no points and 6.5 with 1 point. So it is a permanent buy down for specific cost up front.
Okay. Why would you want to do a permanent buy down when rates are predicted to come back down? Why wouldn't you just wait and refinance?
Affordability.
Affordability, yeah. So maybe somebody's on the verge of qualifying or not qualifying. Maybe we're using one person's income from a household and they need to be at a certain payment.
But what happens if the rates come down to 6 and they refinance? Wouldn't they have just burned?
They would. Right. Okay. So we always lay that cost benefit out.
So what's the break-even point, I guess, for a customer?
Good question.
It depends. So we look at how many years it's going to take to pay it back. That's where the 2-1 buy down has been more popular recently because doing the 2-1 buy down, it costs less money up front. It lowers your interest rate 2% the first year. So if you're at 6.5, that's your interest rate. But we're going to give you 4.5 for the first year, 5.5 the second year, and that third year, if you haven't refinanced, you're at 6.5. So people still qualify for the 6.5. It's just a temporary buy down. And if you refinance in a year and a half, whatever money's left over that we paid up front actually gets a principal reduction.
Yeah, there we go.
So you're not losing the money. If rates don't go down, you're at 6.5, and you just kind of gamble to say instead of a permanent buy down for maybe 0.5%, you did the
so are you seeing a lot of permanent buy downs with this question that she's asking? She's saying maybe the very beginning at that 7.
When they were over 7, we saw more people. What can I do to buy the rate down?
Right.
I think in the 6.5 range, we're not seeing as many people considering it, and the 2-1 becomes a better option.
I think I read historically the average interest rate, which I mean statistics only matter when they're happening to you, is that 7% is historically like the average interest
Right.
rate. But I know people were panicked when
Now,
it
when
went
you're
up to
taking
7.
on, when
Oh,
you're
yeah.
talking about like the 80s when they had 20,
Oh,
25%, that's why that average is 7. But there's this
But
panic because we've been in
7
this
when we got into
3
it.
to 4% for many, many, many years.
Right. And
People are spoiled.
When we started in the business, it was 6.5%, 7.5%.
Right.
Yeah.
Yeah.
So, and again, the Fed came in at that point in time and tried to save everything and artificially brought the rates down. And
Right.
And here we are.
Here we are. Well, let's take a quick break. We'll talk a little bit more about the 2-year buy down.
Okay.
And then we'll also talk a little bit more about some other topics we have
Okay.
coming up. Thank
Cool.
you.
Hi, my name is Jackie Mercier, and I'm a realtor here at Rabell Realty Group. What made me choose Rabell Realty is when I met Kristen and Rebecca, I really liked them. I like the fact that they are very hands-on, and the atmosphere was very family-orientated. It wasn't so corporate. One of the benefits I received from working at Rabell was I was offered the opportunity to join their real estate team, which was very important to me. I wasn't new to real estate, but I was new to the Gainesville area, so I had no sphere of influence. I didn't know my way around the city, and being on the team gave me the opportunity to build my sphere of influence and learn the lay of the land. The work environment here at Rabell is very relaxed, very friendly, and very helpful. None of the realtors have any trouble helping other realtors, answering any questions. If another realtor is not feeling well, out of town, I have no problems, or anybody has any problems showing properties to a potential buyer. It's just a very nice place to work. Rabell has contributed to my growth by Kristen and Rebecca constantly reminding me to get my name out there, get reviews, contact with your past customers because you never know when they're going to need your help again, family members, their friends. So they've helped me grow my business as far as getting referrals and having repeat customers. I would recommend Rabell Realty to anybody who's getting into real estate if they want to learn how to do it right, be able to grow your business, and make some great friends along the way.
All right, welcome. We're back. Thanks for sticking with us. If you have any questions for Eric, please don't hesitate to ask them, and hopefully we'll get them posted and can answer them, or we can answer after the fact. If you're a buyer or a realtor or a seller, we'd love to answer questions about the mortgage rates and the 2-1 buy downs and any other topics we come up with.
What are ideal credit scores for, like, where are rates at if you have a credit score in the 7s? Where are interest rates at if you're in the 8s? Like, where are you seeing things on an average typical customer?
an average typical customer. So obviously, the higher the credit score, the better the interest rate. If you're at a 760 or higher credit score, you get the premium pricing, the best rates.
Okay.
And then it's tiered. So 620 is probably, if I had to guess, about 0.75% higher.
Okay.
So if you're at 6.3, you'd be closer to 7 at a 620 credit score. So
What are they running for, like, FHA consumers?
yeah, FHA is again mid 6s.
Okay.
Yeah, 6.5 to 6 7/8. And the credit score doesn't vary too much on the FHA loan. So it could be
Right.
a higher credit score or lower. It's not a big difference on rate.
Okay.
So
And are you seeing a lot of the 2-1 buy downs in the industry?
we're seeing as helping realtors negotiate where a buyer wants to get in the payment affordability, right? They want to be at $2,500, but the payment's $3,000, right? So it's a good way.
Tell me more about this. No, I'm just joking.
Yeah. So it can make a big difference. And
What does it cost to go from a $3,000 a month to $2,500 a month payment?
So for the 2-1 buy down, and a scenario I ran before here is about a $470 purchase price,
Okay.
5% down, and it's about $9,800 is what
Okay.
it costs. And so instead of maybe lowballing an offer, you go in and ask for a seller credit to pay for that.
Right.
Okay.
Right. And that is a question you have up front with your lender.
Discuss it up front
Right.
because we can
Because you
calculate
need to know the
amount.
number,
Right.
the exact amount, right?
So
you say-
discuss with your landmark lender.
Right.
Discuss with
before-
Eric Remy.
Okay. Beautiful. I love it.
Yeah, we'll calculate it out for you, tell you how much you need.
Now, can the buyer pay for it if they have that cash?
They cannot pay for
Yep.
a 2-1 buy down.
Only the seller can pay for it.
I
Very
did not know
popular
that.
with builders. Again, the national builders, D.R. Horton's offered it.
Yes.
A lot of the big builders offer
Right.
a 2-1 buy down, and it's a great way to attract people in and say, hey, you get a reduced payment for the first
Well, I thought it was
2
very
years.
interesting. So Eric is the first lender to really explain this 2-1 buy down to where we can understand it, because it's new for us. We've been in
Right.
for 16 years and it's new for us. But you have been doing 2-1 buy downs with a
I've done it with builders in the
builder
past.
outside of in Jacksonville, right?
I've done it in Tallahassee.
Tallahassee for years, right? So
Yeah, and again, it was payment affordability. Some people will have someone graduating from college and they're like, I want a lower payment the first year. Going to have more
Interesting.
income and that kind of stuff. So it's
So this
different
could
ways
be
to use
a
it.
sticking around for a while instead of closing costs, having this 2-1 buy down. Now, Elio has just asked, we have a question up here. Will we ever see 3% interest rates? So you're not going to see the 2-1 buy downs when it's 3 or 4%.
No, you're going to have a wave of refinances.
But
so-
what I'm expecting is that we're going to stick in this. Maybe we're going to go as low as 5, and we have no idea when the 3 will come back, if ever, in our lifetime.
Right. Not NAR,
I mean,
but
it's cyclical, so it could be 10 to 15 years.
yeah, Mortgage Bankers Association projected the end of next year a 5.4 rate.
Okay.
Kind of where they're projecting it to be by the end of 2020.
See, I've heard from a couple other people, like Barry Habib, you know him, and he's
Yeah.
talked, and a lot of people are saying that he's saying by the end of the first quarter, we're going to see
We're going to see relief.
relief. Okay,
Right.
well, I
Yeah.
thought, what we were told is that we're going to see the 5s a lot of next year. Maybe not 5, but maybe in the 5s.
5.8, 5.4, yeah. And again, they're going to fluctuate a little bit just based on economic conditions.
What does your rate need to come down? I mean, I think I know the answer to this, but where do you need to see your rate come down to for it to be advantageous for you to refinance? Because, people will see it drop a quarter of a point and they're like, oh, I got to refinance. Where is that like, okay, now it makes sense to do this?
So when we've run numbers, most of the time it's 1% or more.
Okay.
Obviously, the larger spread, the more you're going to save
Mm-hmm.
because you do have to pay for the cost on the refinance.
So with the 2-1 buy down, say you're at 7 now, say the first year you're at 5,
Right.
the next year you're at 6, and say it comes down to 6.4. Is that a good time to refinance before you get to 7 because you're going to save enough?
At 6.4, and again, it varies on the loan size.
Sure.
So larger loans, bigger savings. Smaller loans, I would say
So
probably not.
average right now is about 350.
I would say you're probably going to want about a percent before you refinance.
Yeah, that's what I thought. Because the 2-1 buy down sounds really great, and they're saying, refinance before that
Right.
third year comes
Now,
around.
if it's at
but
5%
if it's
and you're at
sure.
7, yeah, that's
100%,
or
right.
5.4, then go for it.
But if it's at 6.4, it's not really worth it
No.
unless you really want to save that couple hundred a month.
Probably not even that much.
Not even that much. Yeah.
$300,000 loan for every eighth is probably $17 to $20. So, yeah, maybe $100. Maybe.
Yeah. So not even worth it because you have to pay to refinance. It's a couple $1,000s.
Correct.
Right. Okay.
Can we talk
stuff.
about vacation rentals? Because I feel like that is like
Sure.
everybody wants to buy a vacation rental. They think they're going to get a loan on it, which they can, but the rate is higher on a secondary home or investment property.
Right.
What are you guys seeing for those rates?
I haven't pulled one of those up recently, but historically they're about 1% to 1.5%
Nobody's really
higher.
buying them right now.
I mean, I heard somebody had one, it was like 8%, and they were like, I can't believe it's that high.
Yeah.
And I was like, yeah, you guys have been spoiled the last,
Exactly.
couple of years with rates.
And
and
some
you're
of the-
hearing that these markets are going away, in
Yeah.
the mountain and off the coastline. So, and it's because these rates are so high.
Yeah.
When the rates are 7% or even now 6%, in the 6s, they're going to be a percentage higher, you said?
Yeah,
Yeah.
percent and a half higher. So when we were in the 3s, those were 4.5%, 5%. And that's obviously a great rate for, if you're looking back now, saying, hey, I'll take an investment property at 5%. Yeah.
Yeah.
I did.
So, yeah, for sure. Yeah, and they changed some of the guidelines for second homes. That's why they're priced higher because
Yeah.
people were saying it's a second home and then they're going to rent it.
yeah, then they rented
Which
it or
is
Airbnb'd it or
investment.
something.
Yeah.
Yes.
Right.
And so all that changed beginning of last year.
Yeah,
remember.
and you're definitely seeing the side effects of it. I feel like
Right.
people are wanting to buy them and then they back out when they realize, I mean, not only
How
is your
much it is,
mortgage higher, but your insurance is higher. Everything is higher.
Taxes
and
are higher. You don't get the tax exemptions.
what I see is a lot of municipalities just don't want you. Like the neighbors have rallied enough
really?
city and county support to make
They wanna
it
get
very
those
difficult, and HOAs.
second homeowners who aren't really there and they're renting it out of the area and keep it locals only.
Gotcha.
Maybe if you really are a second, that is your second home and you're there every weekend, and you are providing a home, and you're inviting people in, that's fine. But when they see that you're renting it all the time, Airbnb, VRBO, the short-term rentals, became saturated, became huge. And so the entire communities are trying to push them out. And you can see that in certain areas. St. Augustine is one of them.
Yeah.
Pushing out the Airbnbers because there's so many of them.
Yeah. I mean, historically, a second home was a home you're going to use for your personal use and enjoyment. It's available all year round.
You're going to be there all summer or all winter.
I met a couple.
You're going to visit all the time.
On Sunday at the World Equestrian Center, and was sitting next to them, and they're from Asheville, and they're here for, December through May.
Exactly.
And then they've got their house there they go back to. So, yeah.
Yeah,
And like
that's what they're expecting, but it doesn't happen anymore.
Old tutors over in England, they travel for the summer
Yep,
or
they
the
have
winter.
8 houses, and they go here and then go here.
Yep.
So we were supposed to talk about mortgage interest, but the market is so different right now and abnormal, as you're saying. We haven't worked in a normal market ever, and it's still even more of a normal, an abnormal market. But can you talk about mortgage interest for about 2 or 3 minutes? What it is?
The interest itself? Yeah. So mortgage interest, and you want to know how it's like calculated and all that kind of stuff?
Sure. Whatever
I have lots of
you have
interest in
lots
mortgage.
of.
We've been talking.
I know.
Mortgage interest itself is what the investor retains. So when you take out a mortgage, and let's say there's 6.5% interest rate, and your payment is say $2,000, a certain portion of that is the interest. So from an investment standpoint, if you buy a Fannie Mae mortgage-backed security, if you're an investor, you're getting paid back maybe a 6% coupon. So there's about a 0.5% spread between those coupons, which they pay the servicer, a servicing premium, and that's who you make your payments to. So there's 2 portions on the mortgage. The interest is then passed through the servicer. So if you take out a loan from us, for instance, and it gets sold to a Wells Fargo, and then you make your monthly payment, that interest is being passed through Wells Fargo to Fannie Mae. Fannie Mae then turns around and pays the investor. So ultimately 401ks, IRAs, things like that, there's different mutual funds, stuff like that, that invest in those, and it all goes back out. So that 6% is paid back out, and then the money is returned to the lender to re-originate loans. So it's a cycle we have to go through where when your loan is sold, we can continue.
Loans.
Yeah, because if we had $1 billion and we lent it all out, we'd be out of business. So that's where Fannie Mae and Freddie Mac come into play and keep the mortgage supply going. By purchasing these, and that's where you get the underwriting guidelines from. So it has to meet their criteria in order to be purchased.
Now, so there's underwriting criteria from them. Do each banks have different criteria that they require?
Okay. Yeah. Some lenders and banks have different criteria. We call them in the business overlays.
Okay.
So you just take a map overlay, say we want this or that. Okay. A lot of banks, traditional banking like Chase and other companies like that, they usually have a credit score overlay on their products of maybe a 640 or 660. When COVID hit, they shut down their lines of credit, and a lot of people were like, "Oh no, their money was frozen," not knowing how things were going to be impacted.
Sure.
But they put in a 700 minimum credit score requirement on all their loans.
Yep. And these were the big dogs, like
the big guys, the Chase, Wells Fargo, those guys.
Bank of America.
Right. So traditional lenders that are actual direct lenders and sell directly to the agency, they typically don't have overlays. If they do, it's very, very minimal. So they maybe put a lower credit score, like maybe 580 or something.
I can understand where the big guys were coming from during COVID because people heard furlough and they thought, I don't have to pay my mortgage for a little while. So I could see why they would get nervous and be like, whoa. So
now the servicer, they have to continue to pay taxes, insurance, and interest, and then they have to go back to the consumer and collect
Oh no,
it.
I totally get it.
Yeah, it's kind of a big deal.
It's not really what people thought. It was we had people calling, and I'm like, only if you must.
Right.
Don't do this.
Don't do it
because you think you don't have to actually pay. What are you? Oh, I had a question and I forgot what it was.
I do.
Shoot.
There's so many questions about mortgage. Mortgage insurance. Did you have something about that?
Yeah, no, it had to do with all that. We were talking about it. And I was like, ooh, put that over there for later.
I did the same thing.
Okay.
I saw you at like this. You had one too. Does anybody out there have any questions? I'm trying to think.
Do you have any comments that a lot of people are asking you right now, or what's going?
I mean, obviously, our rate's going to come down. That's the biggest question I get.
Yeah.
Oh, I know.
Yeah.
You must be brave to wear your shirt out in public.
Yeah.
Because everybody asks,
yeah.
how's the market?
But people still love to talk about real estate.
Of course, I think so too. It's a great topic all the time to talk about.
It's great.
Who doesn't want to talk about real estate? Only weirdos don't want to talk about real estate.
So we just had one of our realtors text me and say, one of the buyers that she had been working with who was selling a house in New York and moving to Florida, moving to our location, said because they noticed that the market market was just tanking in New York, that they didn't want to sell their house low to buy high here when they can foresee Florida just faltering.
That's what my question was.
Yeah, faltering and not being, mine too. That's what, and not being able to sustain the pricing right now. What do you have to say about that? Because I think we're going to have to talk to these buyers who are freaking out because real estate's local, and these other states, they're not experienced. Like you said, Florida, we're special. We're just lucky to be here.
Right.
So, do you have comments that you tell people about that? And then we'll ask you, what are you saying?
Demand.
Yeah.
I mean, it's simple mathematics. I mean, we have, I think, nationally under 1 million, right around 1 million listings, and we need probably 4 million, 3 million.
And every time we show the data, we are so far off what we used to be, with only 55 and new active houses.
That's what scares me, is there's not going to be anything to sell.
There's nothing to sell, and that's where.
And as we get the rates lower and people start having this desire to buy again, they're like, oh, it's lower, then we're going to go back to where we were, which is we're already seeing multiple offers with that little bit of a drop into the 6s from the 7s. We're having multiple offers.
Yeah, then you'll see prices increase again.
Now, here, you sent something recently, and it was about how Florida was, or Gainesville, and it was all the markets a couple weeks ago, but another realtor just posted it this weekend.
You're
about
behind the
how,
times.
yes, TY. Anyways, about how Gainesville was predicted to falter because 21% of the houses are foreclosures, which I don't think is a huge number.
I know, my face too.
Yeah.
And it was like 0.03% of the houses are not rented. I was
can't see that because I can't keep stuff
0.03
on the market.
I'm like, no, there's no way. So, but we're predicted to fall. Now, this is what the news is telling everyone. What are you seeing in terms of foreclosures? I know you all are a different animal than some of the other lenders, but are you having anyone falter and foreclose
and stuff?
Oh yeah.
Yeah,
go.
I mean, I haven't seen an influx of foreclosures at all. I don't know. I mean,
I'm not
maybe
aware
there's
of any.
another market in
We
Florida
have
that's gonna have them,
one of the
but-
HUD accounts locally, and we don't have anything.
Yeah.
Let's put it this way. I'm seeing unbuildable lots that I know are unbuildable sell.
Right.
So I'm like, I don't know what they're talking about. I'm
Yeah.
like,
Well, the other thing is, I think it was Blackstone or BlackRock or somebody
Yeah.
purchased like 17,000 rental units
Yeah. Oh, yeah.
in Jacksonville. I mean,
Right.
and
So-
they're buying up real estate everywhere.
Yeah.
what
And
I could tell
it's a
you
rental
is
market.
the rental market, I mean, I can't
on
keep
fire still.
rentals. I
Yeah.
have like 1 or 2 rentals that are struggling, but it has more to do with location or condition but I could tell you out of our portfolio, most things are renting very quickly at still really high prices. Now we did a lot of renewals and we only inched it up, $25 to $50 a month rather than last year I was like $100 to $125 a month.
Okay.
Because of COVID, we hadn't done a lot of increases, but I mean, we're almost completely released for August of next year.
Jeez.
For student rentals, and our regular rentals are the same because you can't go anywhere else. So I don't know what they're talking about in that. Maybe there are properties that I'm not aware of, but on our portfolio, everything is leasing.
Well, we just got an email this weekend, and I mentioned to you, and it was like all the upcoming Alachua County foreclosures.
Oh,
and
yeah.
5 of
gotta
them
look at
were plots of land. And I was like, how? You can't even take out a loan for land.
Right.
So, and I just thought, oh,
You
is
have to
this
keep the taxes on it.
someone else?
So I know of some property that is unbuildable, that the reason that the seller got it was because the owner found out it was unbuildable and just stopped paying taxes on it. So,
Right,
because you
so they
can't
bought it.
sell it
So
or do anything.
just like you just
So-
said. So that might be that they can't afford the taxes and it's foreclosing, but if it's unbuildable, like what you're saying, which
But that's
is
not part of
probably
a larger picture where they're saying, hey, we're going to have all these foreclosures.
Right.
When COVID kicked in there, they put so many measures in place to keep
Yes.
people from getting foreclosed on, have given them opportunities to work out, to modify their mortgages and do things like that if they were delinquent.
and plus
So-
they stopped the foreclosure process. So maybe that 21% are still those from years
From
past
before that
were
haven't filtered
right,
through. Yeah.
Exactly.
So,
So,
but-
I don't know. I think with Eric here and the two of us, I think what we're saying is the real estate market locally.
Buy now because there might not be anything later.
I know. Buy now. If
Yeah.
you see it, if you find something, buy now, because there's not going to be anything, and you might get a little bit of a reprieve on your rate, but you may as well refinance it if it's 1% lower.
Right.
So, yep.
Yeah.
All right.
like
well,
it.
Cool. We'll like it. Let's go quickly through everything. Eric, thank you so much
Thank
for
you.
being on
Thank you
here.
guys for
You're
having me.
always so great to talk to, and we're so glad that you've become part of our Rabell family, you could say. Coming in, talking to us and our agents as often as you do. All right. So we're here to celebrate the Christmas holidays, and we're celebrating a couple more local companies that we love, and for our 12 days of Christmas, the Thornbrook chocolates. We love getting gifts, but really giving gifts from here because they're so delicious, and they've been around for a really long time. So if you're looking for delicious chocolates and other gifts for Christmas, visit them, check them out. Thornbrook chocolates.
You missed a good pun.
Did you just
should
go
say
there?
that, I have not. You have to say, because giving is so sweet.
Giving is so sweet.
What do we have? We have Suda Fit Foot.
Yeah, Betsy.
There she
Our
is.
girl, Betsy.
She always participates in our Fit for Fun event.
She does, yes.
Another local vendor. And then...
And she's so fun because
Oh.
she drives around and, oh yeah, there we go. She drives around selling her shoes and her other clothes. And look at this.
I know.
Lender Services from Landmark. What the perfect time to celebrate getting your loans and refi, if there is a refi market, through Landmark Mortgage. And definitely call Eric here because he has lots of information and experience and can help answer your questions or your woes or your fears and abate them. So again, thank you, Eric. Thank you, everyone who's watched. We haven't seen a lot of questions, but maybe y'all are just thinking, what do I ask?
Or if you have a property that you don't want to manage because it's a lot of work, but we don't mind, we're here to be your leasing agent, accountant, repair person, inspector, and overall landlord.
And obviously can get it rented.
Yes, we can. You can reach out to us at 352-213-6410 or online at knrpm.com.
All right. And if you're looking to join a team or just a really great brokerage with great leaders, brokers here, or have questions about getting into the real estate market as a realtor, please give us a call at 352-559-8820.
And if you can't get enough of Kristen and Rebecca and the entire Rabell Realty Group crew, you can reach us on Facebook, Instagram, TikTok, YouTube, LinkedIn, and Google My Business.
And Twitter soon. And
Oh, yes.
like and subscribe to our YouTube page where you can watch all these great videos. And did you know we have a blog?
We do.
Yeah, we do. And there's probably going to be one on the mortgage interest and a couple of other topics coming up. But we always have great topics to read about. So find us at buysellerrebell.com/blog.
And we'd like to thank the Fiesta Media for putting on this podcast and all of our other podcasts. If you would like a podcast of your own, please reach out to them at 352-327-5089.
Thank you. And thank you so much. Please come back. Join us next week. We'll be here Mondays at 2. Thanks again, Eric. We appreciate you.
No problem.
Spirit fingers.
Yeah.
There we go. Jazz fingers.